Okay, let's dive into this. The energy market, it's just such a wild ride, isn't it? It's cyclical, it's incredibly complex, and trying to find real value in there can feel like searching for a needle in a haystack.
So, the big question is, how do you cut through all that noise? I mean, is there really one single magic number that can point you straight to the best opportunities? Well, today, we're going to take a hard look at one contender for that title.
So let me introduce you to the PEG ratio. In theory, it's a fantastic little tool. See, it doesn't just look at a stock's price versus its earnings. It takes it a step further and compares that to how fast the company is expected to grow. The whole goal? To find that rapid growth that the market hasn't quite caught on to yet. So, now that we have our tool, let's put this thing to the test.
All right, first up, we'll start with a case where the PEG ratio seems to work exactly like it's supposed to, shining a big, bright green light on a potential winner.
We're looking at First Solar, a huge player in the renewable energy space. And what's really interesting is that while so many of their competitors are struggling just to turn a profit, First Solar, well, they really stand out from the crowd.
And here's our number, a PE ratio of around 0.5. Now, the general rule of thumb, right, is that anything under 1 is considered undervalued. So a number this low suggests its growth rate is literally double its PE ratio. On paper, this is a screaming buy signal.
And the cool thing is, the story behind that number really seems to back it up. First Solar is one of the biggest US-based solar panel makers. And why does that matter? Well, it's huge because while its foreign competitors are getting hammered by tariffs and squeezed on their profit margins, First Solar is actually getting a boost from US government support, like the IRA law. It's kind of like a stable island in a very stormy sea.
But hold on, even in this seemingly perfect case, that number doesn't tell you the whole story. See, big solar projects are financed with a lot of debt, which makes them super sensitive to interest rates. If rates stay high, demand for their panels could really slow down. It's a key risk you absolutely have to keep in mind.
Okay, so with First Solar, the PEG gives us what looks like a clear signal, but with a pretty big what if. Now let's switch gears and move from green energy to traditional oil, where the PEG ratio starts acting less like a clear-cut signal and more like a relative clue.
This is Diamondback Energy. Now, unlike the giant oil majors you always hear about, Diamondback is known for being a really nimble and highly efficient producer out in the U.S. shale fields.
Now take a look at its PEG ratio. It's around 1.1. If you just followed that simple rule of thumb, you'd look at that, say nope, not a bargain, and just move on. But that's where you'd completely miss the real story.
And this chart just illustrates the point perfectly. I mean, look at this. When you compare Diamondback's 1.1 PEG to the oil industry's average, which is way up there, over 2.5, you suddenly see a completely different picture. Relative to its peers, Diamondback is trading at a massive discount.
You see, its value isn't just about explosive growth, it's all about efficiency. Diamondback operates in the Permian Basin, the most productive oil field in the U.S., and they do it with incredibly low costs. This means it can stay profitable even when oil prices take a nosedive. Plus, when times are good, it often rewards its shareholders with extra dividends.
Okay, now for the really interesting part. What happens when that beautiful, low PEG number might not be a green light, but a big red flag, a warning sign?
Our final case study is Canadian Solar. And let me tell you, this one is for investors who have a very high tolerance for volatility, because things are about to get complicated.
I mean, just look at that PEG ratio. It's less than 0.5. That's even lower than First Solar's. It looks like the deal of the century, right? The ultimate hidden gem? But is it just too good to be true?
So here's the crucial context the PEG ratio completely misses. The stock's price has fallen off a cliff lately. It's actually trading for less than the stated value of its assets. This is what investors call a falling knife situation, and trying to catch one of those can be really dangerous. Now, to be fair, if the solar industry stabilizes, the potential for a rebound is enormous. But that is a very, very big if.
And here it is. This is the single biggest risk that the PEG ratio completely ignores. Much of its manufacturing is based in China, which makes it highly vulnerable to geopolitical tensions, tariffs, trade wars, you name it. That's a massive risk that no simple formula can ever capture.
So, this brings us to the most important question. Why? Why can one number tell three completely different stories? This is where we get into the common traps of using the PEG ratio.
especially in a cyclical industry like energy.
First off, there's the classic value trap. Here's how it works. Let's say last year, oil prices were at a record high. So an oil company reports these massive earnings. That's the E in our ratio. This makes its PE ratio look incredibly low, super attractive. But here's the catch. If everyone expects oil prices and earnings to fall next year, that means you have negative growth, a negative G. The stock looks cheap today, but it's actually just priced for a downturn.
The second big trap is remembering what the PEG ratio was built for in the first place, growth stocks. I mean, think about it. A lot of people invest in big energy companies like a Shell or a BP, not for growth, but for that stable, passive income from their high dividend yields. Since these companies aren't growing at a crazy pace, their PEG ratio will almost always look high and unattractive, even if they're fantastic investments for an income-focused portfolio.
So where does that leave us? Is the PEG ratio a compass or is it a trap? Well, the truth is, it's not a magic number. It's really more like a magnifying glass. In the energy sector, a low PEG on a stable company like First Solar is a signal to dig deeper into the risks. A high PEG on a company like Diamondback is a signal to immediately check its peers. And a rock-bottom PEG on a falling company like Canadian Solar, well, that's a signal that the real story isn't in the numbers at all. It's in the news. The PEG never gives you the final answer. It just helps you ask better questions.